I'll go ahead and get started. You can tell right away I'm not this good-looking guy on the front cover. My name is Pete Knorr. I'll introduce myself a little bit more in just a couple of pages. We're going to talk today about how discount rates affect lump sums. And in particular, we're going to use ExxonMobil lump sum as the example. So if you're from ExxonMobil, that should work really great for you. But if you're not, don't go away because the principles are all going to apply. So you'll definitely get a lot out of this. Okay, so first of all, just a few slides on Bogart Wealth. So Bogart Wealth is a registered investment advisor. In the space of financial advice, there's kind of two worlds. One world are the folks who work for an investment bank, like they work for Merrill Lynch, or they work for Morgan Stanley, or they work for Wells Fargo on the investment bank side. The other world are the registered investment advisors. We're independent of any bank. Now, our clients, in our case, they have their accounts at Charles Schwab, and they give us a limited power of attorney to be able to interact with their accounts, buy and sell, move money among accounts. Okay, so these two different worlds. And as a registered investment advisor, we are required to be a fiduciary in everything that we do, which, what does that mean? It means that we're legally obligated to put the client interest first. If we have any conflicts of interest, there has to be full disclosure. We need to always act in good faith, be very transparent, fee only. So those are some of the differences between being a fiduciary and having to meet only a stockbroker requirement. We're a relatively small company. The advisors here on the top row. So I'm Pete Knorr, financial advisor, a vice president of the company. The rest of the team is like the portfolio management team, for example, or the financial planning team. So we have a lot of people to support the advisors, to support the clients. And by the way, I should say that I have the chat open. I have the question and answer open. So if you have questions as I go through this, you can post them there, and hopefully we'll get all of your questions answered before we're finished. So we also have a tax team. So we're full service in terms of doing tax pro formas, doing tax optimization, and the tax team can actually prepare and file your annual tax statements if you want. We have 3 different locations. I don't know how convenient they are to you. The company started in McLean, Virginia, just a couple of freeway exits north of Gallows Road. If Gallows Road in Virginia means anything to you. But we became aware at some point that Gallows Road would not be with ExxonMobil for long. We moved to Houston, or I shouldn't say moved to Houston. We opened another location in Houston, and then obviously have to have one in the Woodlands as well. So today, the biggest is still McLean. Woodlands is our second biggest office. And I'm out here in West Houston. For those to whom that's the most convenient, be happy to meet with you out here. Okay, so why Bogart? First of all, our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. The intergenerational part is very important. So your children, your parents can be some big variables in your financial plan, and we can help you with that, and we can help them directly. And these are the different kinds of strategizing and optimizing that we can get into. I already mentioned in-house tax optimization and preparation, Roth conversion strategies, actually part of tax optimization, Social Security maximization, full service financial planning, and financial wealth management. The not at all hidden agenda of doing these webinars, which are 90% informational, we're getting there in just a second, is to encourage people to come in for a one-on-one financial strategy session. This talk today is one of a series. So the retirement planning timeline is kind of the headline. It covers every topic in retirement planning, but only about 1 inch deep. So the rest of these then dive down into details like how do you create income in retirement? How do you plan when to start your Social Security benefits, tax planning, tax optimization, estate planning, NUA, and other post-retirement income strategies, long-term care planning, Roth versus traditional. So we have this entire series of informational webinars, and hopefully you'll come to every one of them. Now about discount rates. So the first thing to know is that there was this law in 2006, and it really started to take effect in 2007. It had a 5-year phase-in period, so it was not fully in effect until 2013. And first of all, it limits companies who are offering lump sum options. In some cases, it says if you're not funded sufficiently, you can't have a lump sum option at all, or in another range of funding sufficiency, you can only do a 50% lump sum, but not 100% lump sum. Okay, this one happily has never affected ExxonMobil. They've always kept their funding above that level to be able to do 100% lump sum. But that's one of the things that it did. It defined the discount rates that can be used for calculating the lump sum. And of course, today's talk is all about what are those discount rates and how do they work. So we're going to get to that. It defines the actuarial tables to be used. And we're going to say more about that. It allowed non-spousal beneficiaries to do rollovers and sort of created the stretch IRA. Well, okay, a law in early 2020 took away a whole lot of that flexibility, but still some of it remains. It made it clear that after-tax balances can be rolled over to a Roth IRA. So this is something that, well, when I retired from ExxonMobil in 2013, this was still not a thing that it was fully able to do. It also said the company match could be diversified. So this is why to get the full 7% match, you used to have to put all of that match money into ExxonMobil stock. Now you can put that 7% anywhere you want to. And then it defined IRA and 401k contribution limits. The main parts that we want to talk about today are defining the discount rates and the actuarial table. So first of all, there are people who are grandfathered for the Pension Protection Act of 2006. The way that ExxonMobil defined it was they said if you're over 50 by the end of 2007 and have at least 10 years of service before January 1, 2008, you're grandfathered. Okay? Another way to say that would be, hey, if you're going to make 55 and 15 by the end of December 31, 2012. So I said this law, 2006, took effect in 2007, but a 5-year phase-in period. This is the end of the 5-year phase-in period, 55 and 15. Okay? And the only reason they didn't define it this way is for those few people who might have had a break in service They wanted to say, no, it's not 55-15 by 2012. It's 10 years, 50 and 10 years by the end of 2007. Okay, for those people who were born before 58 and hired before 98 and don't have a break in service so that they have at least 15 years of continuous service, those people are grandfathered. And for them, they use the old rules, which is 95% of the 30-year Treasury bond rounded to 0.25%. We'll get to that in a minute. And they're stuck with using the old ExxonMobil year 2000 mortality table. So they are not allowed to update it. And Treasury bonds have lower interest rates than corporate bonds, so that's good. But as years have gone by, the mortality tables say that there's several years more life. So there's a trade-off with being grandfathered. So the grandfathered people, again, born before 58, hired before 98, they're using something calculates very simply right off the 30-year Treasury bond. And you can see there's ups and downs. And each of these are important. We'll get back to how important in a few minutes. But the trend is clearly been down, down, down. And you can see it hit an absolute low in the history of man here about a year ago. And I'm fond of saying that when Christ threw the money changers out of the temple, they were charging a much higher interest rate than they are today. So for the grandfathered people, this first bit of logic applies to everybody. The data from, for example, the fourth quarter of 2018 applies to the second quarter of 2019. There's always one dead quarter in between the data and what it applies to. And, the rationale for that is that the number, you have time to think about that number before it applies to you, okay? So you take the data from the second quarter, for example, that we're in right now, and there's still 10 days left as of when I got the data. Last Thursday is when I stopped collecting it. The weighted average, 2.288. 95% of that, 2.1736, rounded to the nearest 0.25%. And that is 2.25. Interestingly enough, if you take the last data point, 2.2, and multiply it by 95%, it's going to round down to 2.0. Okay. So what that means is if the next 3 months are like the last 2 weeks, that the first quarter next year will be lower than the fourth quarter this year. It'll go back down to 2.0. But, that's a lot of what if. Don't quote me on that. And this is so mathematically precise that we can say things like, well, for it to round up to 2.5, the next couple of weeks are going to have to average 3.645, and we can say that's virtually impossible. It would take an asteroid landing that destroys a continent for that to happen. And to reach 2.0, it would have to average below 2. Say, that's pretty unlikely too. So we can say with 10 days out that with almost mathematical certainty, we know what the answer is for the fourth quarter of 2021, okay? Everyone else, which probably means everyone in the room at the moment, was not under 50 by the end of December 2007, okay? So in other words, born after 1957, hired after 1997. And so for them, we're going to use the corporate bond yield curve, okay? Well, that's what they say. What it really means is these 3 segmented rates, that I'm going to talk a lot more about, based on high quality corporate bonds. So they call that the high quality market. And here is the website for where you can go find those published. So they're published by the IRS, but they're actually calculated by the Treasury Department. And corporate bonds are higher risk than government bonds, and so they have higher yields. And higher yields are bad. And I'll get to just how bad in another couple of pages. And they use updated mortality tables, and longer life is good. Now, let me say just a little bit more about that. So the company is not required to use the latest mortality table every year. They have to update it at least once every 10 years. The last time they updated was 2018. So they don't have to update their mortality table till 2028. And that may be good or bad with the COVID mortality. I think the 2020 table is one you don't want anybody to use. But okay, so there's a trade-off of higher discount rates, but longer life. And we're going to get into what does all that mean? How does it affect my pension? So this first affected people in 2013. Okay, so there's a question that came up. Does ExxonMobil provide any advance notice when they change to a more recent mortality table? And I can only tell you my experience, and my experience is nope. They're not going to tell you that. And the only way that I know it is because I'm looking at each year's mortality table, and I'm noticing that I'm getting a shift in answers from the ExxonMobil tool. And so then I go in and try to figure out what table they're using. So no, they don't really give an answer or give a prediction of that. Thanks for the question. Okay, so this is partial history for those who are subject to the Pension Protection Act. So again, we've got, the current quarter. It's going to apply to 2 quarters from now with 1 dead quarter in between. And these segmented rates, you can see where they were in the middle of 2019, 2 years ago. And then they, they were coming down, but they really dropped precipitously based on the events of March and April last year. And here I'm just following segment 1. You can see the same sort of thing in segment 2 and the same sort of thing in segment 3. And you can see that all of these are coming back up now, but they don't always all move in the same direction. So like you can see this one went up and this one went down. So in order to help people understand what's the impact for them, we publish the single equivalent rates, and I'll get to how we calculate the single equivalent rate. But it's basically saying, instead of working with 3 segments, what is the one discount rate I could use that would give me the same answer? And then I can compare 1 quarter to the next a lot more easily than trying to look at these 3 numbers that are moving sometimes even in different directions. So that's the purpose of the single equivalent rate. And you can see that from first quarter to second quarter, right in here, there's no difference to at least these 3 significant figures. In the next decimal point, there might have been a change. And then you can see there was a big change from the second quarter to the third quarter. So this is why there was a mass exodus June 1. And then if you had listened to this a month ago, I was predicting that there would be a further increase, but not very big, going from the third quarter to the fourth quarter. Well, as things have progressed, we're now saying, this could be couple of basis points. It could be nothing. Okay, so why do we have different numbers at age 55 and age 60? Well, I'm going to get to that in just a minute. But first, okay, I can't go back nearly as far as I did with the 30-year Treasury bond, but still this kind of gives you, this is estimated single equivalent rate to be able to give you a visual that says these have also gone down. Now, the one thing that's a little bit more eye-popping that you didn't see on the 30-year Treasury is what happened with the financial crisis in 2008, 2009. You remember toxic bonds. And so, so there was this kind of scare, and boy, you don't want to retire in the middle of a financial crisis and be relying on corporate bond rates. And similarly, there was this blip, but it was so short-lived that you don't see it in quarterly numbers at all. You only see a decline. Okay. All right, so now we're going to get to an example that illustrates the importance of life expectancy, what age you are when you retire, and how these interest rates get applied. So this example is someone who's retiring at age 60, and in the third quarter, so we have these three segmented rates, and I sort of back calculated what would their annuity have to be to give them exactly a $1 million lump sum. Okay, so that answer was $4,797.57 a month, which gives them about $57,571 a year of an annuity. And the way you would calculate then that present value from that annuity, you could set up a table like this, and you could say, we think they're going to die on their 84th birthday. Okay, so that's the average life expectancy of someone who's 60 years old in 2018. So the 2018 mortality table, an average life expectancy of 84. By the way, it's the unisex table. Okay, so if you're all scrambling right now to look up the mortality tables from 2018, and you'll see one for men, one for women. It's the unisex table. So every year, they're going to get that annuity payment. Well, okay, they're going to get it every month. I'm simplifying to fit it on the page. The discount rate, segment 1, applies to the first 5 years. And it is, in fact, the average of interest rates from 0 to 5 years, according to the calculations from the Treasury Department in the high quality bond market, A, AA, AAA. So that's how that number is derived, published by the IRS, applied this way. Segment 2 then is the average of bonds from 5.5 years up to 20 years. 2.73. So you'll see it applies to the next 15 years. And then anything beyond 20 years is segment 3. So segment 1, segment 2, segment 3. The discount factor, you know, a lot of people are used to, I'm going to take the discount factor from last year and apply this year's discount rate and get the next one. That doesn't work in this case. So let me illustrate with year 6, where you see there's a huge drop in from year 5 to year 6. So basically, to calculate that number, it's 1 over 1 plus 2.73% raised to the 6th power. And so the present value is answering the question, how much do I need to invest today at a guaranteed rate of 2.73% for the next 6 years in order to have the money that I'll need to make this annuity payment when this person is 65 years old that year until they're 66, okay? And the answer is 48,980. Another thing to point out is when you get to 80 years old, you're at segment 3. This is all the way down here to less than half of its value. Okay, so the payments far in the future are worth a lot less than the payments made today. Okay, so you add up all of those, you get $1 million, and that's how you calculate the lump sum from the annuity. The pension guarantees an annuity. That number doesn't change. That's what the pension guarantees. The lump sum is going to be based on interest rates, and it's the interest rate that's in effect at the time of your benefit commencement, not at the time of your retirement. So if you retire at 55, you know that your annuity had a 25% haircut, right? You're getting only 75% of what you would get if you waited till 60 to take that annuity. So while it's only 75% of the value, you're going to get it for 5 extra years, roughly, because you're still not going to live any longer than if you waited and took it at 60. So basically, you're going to get a smaller payment, but for 5 more years. And thinking of it this way helps you then think about, well, then how much were those extra 5 years worth? Well, they're 5 years at the end. I know you think of them at the beginning because you're 55 instead of 60, but stay with me for a minute, because the number at 60, you don't get until you're 60. The number at 55, you get when you're 55. So you've got 5 extra years, but they're highly discounted years. They're only worth about half. So you're getting like 2.5 years in today's value. 2.5 years out of 25 years, this is 24, close enough, is 10%. So the lump sum at 55 is 85% of the lump sum if you wait until 60. Now, you didn't like that? Work it out on the table. Okay, so the single equivalent rate, as it turns out, is 2.77. Now, how the heck did we get that number? Well, there's a couple of ways you could get it. One is the internal rate of return method. So you take this table that I had before, you say, I'm going to invest $1 million today, the lump sum, in order to get these annuity payments. You say in Excel, put in the formula equals IRR, internal rate of return, of this range, minus $1 million plus 57.51 for 24 years. And it's going to tell you 2.77. And hopefully that's the number I had back here. There you go, 2.77. Okay. And if you ran the same example and added 5 more years to the table, what you'd find out is that you got that 2.79. Okay. So the other way is you could do a goal-seek method, which would be you'd replace these numbers with one number. Okay, no, not these numbers, the interest rate with one number. And I would make my initial guess equal to segment 2. It's the one that we used for 15 years already. It's probably going to be pretty close to segment 2. And now you're doing a goal seek to get the present value back to the $1 million that it started at. And it's going to give you the same answer, 2.77. Okay. So basically, this is the way that you would calculate the single equivalent rate if you wanted to do it yourself. And okay, so now the next question that people always want to know is, so how much is this going to change as interest rates change. So I'm going back to the previous example. We're using the interest rates as the base case is what they are for the third quarter 2021, someone retiring today and taking their benefit today. And first, I'll tell you, the rule of thumb is a 1% change in interest rate is a 10% change in lump sum. It's pretty linear between 0 and 1%. It gets highly nonlinear as you go up in interest rates. So basically, it's hard to imagine these decreasing anytime soon, but just for illustration, if you decrease the interest rates from here by 1%, and this one became negative, I don't like that, but that's the way it is. You basically would get, instead of $1 million, you'd get 1.109. Okay, so it's about 11% change, not my rule of thumb. And if you increased rates, okay, so if you increase rates by 1% here, you're getting 9.5% decrease. So it went down to not 900,000, but 905. So it's minus 9.5%. So you can see that's a pretty good rule of thumb, but it's not perfect. It's not perfect. But this sort of explains that if you're thinking about lump sum and, you know, like you're retiring before 60 and you're thinking, I'm going to wait to take the lump sum because, number one, if you start drawing on that money out of the lump sum before age 59.5, you may very well have to pay a 10% tax penalty. So hopefully you don't need that money before you're at least 59.5. And so you're waiting to get the full pension that you were vested in. Well, it's a trade-off between waiting for that pension to get bigger versus, but interest rates might make it get smaller. So we're generally telling people, you know, if you're retiring before age 60 and you can afford to defer the pension, defer the pension. And if it's a lump sum, you defer it until interest rates start changing enough to start wiping out the benefit that you were getting from waiting. And it doesn't take a whole lot. It takes 0.25% per year, more or less, of interest rate going up to wipe out the benefit of waiting. Okay, so again, if I'm retiring now, should I delay the lump sum? And we're saying, well, if you're retiring before 60, you know you're going to get a benefit from waiting. And if you're taking the lump sum and you expect interest rates to stay the same, or certainly if you expect them to fall, then you should wait as long as interest rates are falling. But in a case like happened between June and July this year, and they make a jump up of almost 0.5%, then, okay, that's now wiping out about 2 years of waiting to take the pension. So people are generally going to go ahead and take it at that point. Okay, so this is not precisely about the impact of the lump sum or interest rates on the lump sum, but it's related. So what I'm illustrating here is a roadmap for somebody who's thinking, I'm leaving at the end of this year and I'm thinking about benefit commencement January 1, 2022. So when do I need to do what? And we have this nice colorful version of it. Yeah, I'm an engineer. I kind of like this version of it, a little bit more detail. And what I would say is let's start looking right here. Begin with the end in mind. So you wanted your lump sum check to be delivered on January 1st. Okay, so it's going to arrive within 1 to 2 days of that. In order for the check to arrive on time, you had to have your paperwork in completed and accurate at least 35 days before that benefit commencement date. 30 of those days are required by federal law. The other 5 days is, well, one way to say it is the belt and suspenders approach of ExxonMobil. Another way to say it would be, well, what if you made a small error that could be corrected in those 5 days? So they're doing that because they're a benevolent parent, but whatever. 35 days prior to the benefit commencement date in order to get your check on time, okay? So that means that you had to receive the package in time to do that. And so basically what it says is it takes them a while to get the package to you. Now, the good news is it used to be 4 to 7 weeks. And it's now, in most cases, they get it to you within a week. So they've really streamlined the process just in the last 6 months. So that's great. And they say you can request it 90 to 120 days out. The reason you can't request it any further out than that is they don't even know the discount rates yet. Okay, so, you know, like right now, we know the discount rates in the third quarter, and we do not know them yet for the fourth quarter. And we will not know them until the middle of July, because this website, like the May numbers, for example, just got updated last week. And so that's why we're always predicting them. And, you know, I'm really proud of our prediction model, but it's not perfect. You can see right here in the middle of the shutdown and panic with the pandemic that the number actually went up. That's the actual number. The model's the one with the wide dots on it. So we said that it was going to go down from April to May, and in fact, the government reported it going up. Here we agreed it's going down, but the government said it wasn't going down as much as we were predicting. So how do we predict? We predict it by looking at treasury bonds. Okay, I know these are corporate bonds. Okay, but stay with me for a minute. We look at corporate bonds and we look at treasury bonds and we look at corporate bonds. The problem is there's no good data source for the daily movement of the different qualities of corporate bonds. So we're looking at the entire corporate bond portfolio, the whole world of corporate bonds, and comparing those with treasury bonds, because treasury bonds are going to be higher quality than the highest quality corporate bonds, and we're interpolating between those. Okay, so usually we are so close that you cannot see any daylight between our model and actuality, but sometimes we're wrong, and you can see daylight for May. We were really close, but okay, there's daylight in segment 3 for May. So we may be wrong in our projection that we have here for the fourth quarter. And what direction was it? Well, the government said that May was lower than what we said. And so that made these numbers come down. We'll know in the middle of July. But okay, that's back to why it is that you cannot request it more than 120 days out. And sometimes they can't get you the package right away because they don't know the numbers yet. So they could not get it to you 120 days in advance if you're going for a January 1. You can request it though. So basically you get your package now within a week or so of requesting it, unless you have a quadro. Okay, what's a quadro? So if you've been divorced and your ex has some lock on your pension benefit, that's called a qualified domestic relations order. It will be in your divorce decree. That's a quadro. And then the government, or I'm sorry, the company has to use an outside law firm to analyze that and come back with, okay, this is the impact on this person's pension. So that takes a little bit longer, and it's going to be more like the 4 to 7 weeks that they used to tell everybody. So if you have a quadro, be sure you have an extra copy of your divorce decree, even if you already gave it to HR, okay? They will do a charade of looking for your divorce decree in Curitiba, and then gosh, they won't find it. So make sure you have another copy of your divorce decree if that applies to you. So then you get the intent to retire package. We're happy to review it with you, whether you're a client or not. We're happy to review it with you, help you make the selections. So you get it in at least 35 days in advance and it shows up on time. What if you didn't make up your mind until Thanksgiving and you decide that you want to leave with your benefit commencement date January 1st? Well, it's impossible the check's going to arrive on time, but you can still get the discount rate. So officially, you will still get the benefit commencement date you requested, just the check's going to come a little late, okay? And if you're taking annuities, same story, the checks will come late, but you'll get 2 of them the first month, or 3 if they're that late. Okay, the rest of this has to do with rolling out of the savings plan for another day. So what should you do now? Well, clearly you should have a plan. And the most important part of the plan is understanding what your cash flow needs are going to be. So understand what your current spending is, and then thinking about how that's going to play out differently in the future, particularly if you have kids in college now, your expenses might be lower in the future. Or you have kids in high school now, your expenses might be higher in the future. So, those kinds of things that you want to think about. And, obviously we want to help you understand how all this impacts. We want to help you with your financial planning. But, we're like the last people to be able to tell you what your budget should be. So, okay. Now, switching gears slightly to this presentation, like most, not all, of our prior ones, is being recorded. It will be on our website. So basically, you would go to bogartwealth.com and you could click on events and video events, or you can go directly to that link of the video events. And this is what it will look like. So like here's a prior one. They all say they're presented by Mike Duffy, by the way. So he's one of our advisors, and he's kind of the guru of our website. He uploads them, so they all say he's the presenter, but it'll be whoever actually presented it. If you want to know in advance about the future topics and you're not already on our email distribution list, you can sign up over here. You can see we're not even asking for a phone number. So nobody's going to call you and bug you about it. They're just going to add you to the distribution list for our future webinars. Now, the other thing is that we also put out a weekly email with the latest projections of these discount rates. So, I showed you this picture before. And so you basically get like this picture and this table updated every week by email. If you want that, then where you go is you go to bogartwealth.com and click on Contact Us. Okay. Yeah, here we're asking for a phone number and even says it's required. But if you put in the brief message that, you know, I just want to be put on that distribution list, nobody's going to call you. Don't worry about it. So, so those are places to sign up for knowing about the future events. And again, I want to remind you that, you know, our whole purpose of doing these informational webinars is get our name out in front of people, have you kind of meet some of us by video and say, these guys sound like they know what they're talking about. Maybe they can help me with my financial strategy. And it costs nothing. And you might say, well, anything that costs nothing has zero value, but not in this case. So basically, this is our marketing, okay? Doing these webinars and doing these one-on-one free financial strategy sessions. This is our marketing. Think of it as a marketing cost. Okay, a question came in. Do I think interest rates will rise in the near future and by how much? So I first have to say I'm really rotten at predicting anything further ahead than a couple of months. But we see there's clearly a long-term trend downward. And with the 30-year, we saw, you know, that trend has been going on for a long, long, long time. Why is that? That is a world of lower and lower inflation that is driving the downward trend in interest rates. Now, when I was kind of in your shoes and I was thinking about retirement, but not quite there. So kind of in this time period, let's say, and, you know, people would put up this chart and say, this can't keep going on like this. Well, it did. And then we're 2009 after the financial crisis, you know, 2010, 11, and they're saying, say it's popped back up already. It came back down because of the Greek crisis, but it popped right back up again. Oh, there was a second Greek crisis. So this all has to do with the end of hundreds of years of a continuously increasing population in the world. So it started in Japan 35 years ago. It moved to Europe. It's now not quite in the US because of our immigration system, or lack thereof, however you want to think of it, it doesn't matter. We got a lot of immigrants. And so we do not have a declining workforce quite as dramatically as they have in Europe, or quite as dramatically as they have in Japan. That is what's driving this long-term deflationary trend. Now, there are a lot of people worried about inflation at the moment. The Federal Reserve says you shouldn't worry that much. It's just supply chain disruptions, but their actions say, but they are a little worried. So it's very possible that interest rates are going to pop back up like they did in this sort of period of time, from what was at that time all-time lows. Okay. It's very possible that they're going to pop back up, but to where? So the only way they're going to get back up above 4% kind of numbers is if we really do have sustained inflation, that it really is not just about supply chain disruptions. That, for example, that there's huge number of women that are missing from the workforce don't come back ever. Then okay, we might have spiraling wage inflation, and that will feed consumer price inflation. But otherwise, no, I really don't expect any real change in this long-term trend. We're going to bounce off of this bottom. There's no question about it. We can easily get up to 3.5 on an equivalent rate basis, which would be another not quite 1% above where we are today. But getting up higher than that feels unlikely. Okay. So another question came in, said, this person's not yet 60, and they're trying to figure out exactly when to pull the trigger. So what else should they be looking at other than interest rate? Okay, I don't have a slide for this, so I'm going to wave my hands a little bit. You might want to take notes. The pension is 1.6% times years of experience times your pensionable pay, which is the highest 36 consecutive months out of the last 10 years, which for everybody means it's the last 3 years, unless you leave the company on restricted duty or something like that. It kind of protects you for that. So your last year, 3 years of salary kind of rolled in together. Now, if you're an executive and you have additional payments planned, all right, we need to have a separate conversation about that. So for everybody else, that's it. 1.6% years of experience, pensionable pay. There's a Social Security offset. We're going to ignore that for now. It's kind of a second order effect. So how many years do you have with the company? Tells you how much your pension's going to go up based on one more year of experience. So let's say you only have, let's say you have 33 years. Okay, one more year with the company is 1 over 33. Okay, 3% more on your annuity for every year of service. It's also 3% more in your lump sum. It's 5% less of a haircut on the annuity for being 1 year closer to 60. So a combination of 8%, even if your pensionable pay doesn't go up. Your pensionable pay will go up even if you don't get an increase, as long as your pensionable pay today is lower than your current salary. Okay. And the pension projection tool never shows that. So that's a reason to have us do a pension projection for you to help you understand these different effects. So 8% is kind of a good rule of thumb of how much more you're going to get each year. Now, for somebody who's over 60, then they're still going to get that 3%, but they're not going to get the 5. Okay. So now how does that trade off with the interest rate? So if the interest rate goes up by 0.25%, that's 2.5% change of the lump sum. And on $1 million, that's $25,000. Okay. So basically, they're 2.5% that they're going to lose if the interest rate goes up, just about offsets the 3% that they're going to get for one more additional year of work. Now, that doesn't mean they were working for free. That just means the lump sum is not going up in that year. And if the interest rate goes up by 0.5%, okay, now they're losing money in the lump sum versus if the interest rate has stayed the same and they worked another year. Okay, so if a person is not yet 60, well, the interest rate has to go up be more dramatic than that, because now we're talking about an 8% increase. So it has to go up by like 0.75%. And can the interest rate go up by 0.75%? Sure. I mean, look at what it did here between 98 and 2000, right? Or what it did here is a full percentage point between like 2013. So this is when I retired, and 2014, it went up by a full percentage point. So those people were actually losing money on their lump sum. But we like to say maximizing your lump sum is not the same thing as maximizing your retirement security. Okay, you almost never are going to be more secure because you retired sooner. Now, almost depends on, well, how long later. So certainly between June and July this year, well, that was dramatic. Working one more month was not going to help you if you were taking lump sum. But if you were working one more year from June 1 this year, I bet those people are better off working another year. Because it's not just the lump sum, it's a difference between you're adding money to your savings or you're living off your savings. Okay. Now, an example I like to use as an engineer, I like to go to the boundary condition. So the boundary condition is, imagine someone, not you, who dies at their desk at work. They did not run out of money in retirement. Okay, you also know they didn't enjoy a single day of retirement. So this is kind of the dilemma of retirement financial planning, is that, if you work till 85 and you die at 86, your plan's going to work great. But, that's probably not your idea of a good plan. So, yeah, that's the dilemma. So very happy to help anyone with your individual numbers, do a pension analysis for you, help you understand the trade-offs in your particular case. So I'll wait another few minutes to see if there's any more questions. I think I had like one more slide, which was, yeah, so here's the names and numbers of the individual advisors. If you want to contact one of us, and we offer, I like the word free. I have the kind of mind that always looks for what's the opposite of something. And complimentary, I think, well, we sure don't want these to be insulting. But okay, it's free and confidential to help you with an entire plan or just some part of it, like understanding the lump sum versus the annuity. And I'm not seeing any more questions. So I'll thank you for attending. And we do an update on this particular topic every month. So if you feel like a second dip would help you, be glad to see you again next month.